And thank you all for coming along this evening to hear about Impellam. Darren will be joining me, flitting up and down as we run through the slides. Impellam, let me tell you a little bit about us. And before I give you some stats and some numbers and some context, I'm just going to tell you what it is we're all about. And our vision is to be the world's most trusted staffing company, trusted in equal measure by our investors, our people, our customers and our candidates. And that's really, really important to us that we do what we say we're going to do. So if we come out and talk to a group of investors, we tell them what we're going to do, we come back and we tell them what we've done. And we do the same with all of our stakeholders. That's very important to us. And what we do is provide fulfilling work for people, and in so doing make our customers' businesses better in a changing world. The words trust is very important to us, and you'll see that woven through the presentation. Some headlines: we are the second largest staffing company in the UK as measured by turnover, and the sixth largest in the world now following our recent acquisition of Bartek, as measured by the sums we manage on behalf of our customers. So we have revenues of 2.3 billion, and on top of that we manage another 4 billion of spend. So we're quite big, and we're listed on AIM. We do that through 270 outsourced contracts, and that's a feature of Impellam compared to other staffing companies, and in 220 locations across the world with 3,100 people. The key stat on this slide, probably for you to take away, is that every day we put 120,000 people into work across the world, across a multiple range of disciplines, from doctors, nurses, scientists, accountants, lawyers, blue-collar workers, you name it, we have them working somewhere in the world. So how have we done this year? These slides are directly from our Investor Roadshow. We're giving you everything that we've given our existing investors. And I'm delighted to say that as well as delivering on our financial commitments, delivering on our promises to the city, we made significant progress this year, delivering our strategy, the strategy and the vision of becoming the world's most trusted staffing company. And that's involved a lot of cultural transformation. The group has been repositioned over the last 3 years. A big part of what we did during the year is to acquire 4 great businesses, 2 at the end of 2014, which we integrated during 2015, and on the back of that success, a further 2 acquisitions in 2015. And we are developing something of a track record in being a very good acquirer of businesses. In the staffing sector, which is essentially all about people, value can walk out of the door when you do an acquisition. We have become very good at our people due diligence. We spend an inordinate amount of time with the people of a business that we're going to acquire to make sure that their culture matches our culture. As well as doing all the financial due diligence, which clearly we do, we find that's the difference that makes a difference, making sure that the management teams will be comfortable and happy working in the way we work, behaving in the way we behave. As a consequence of that, we have become an acquirer of choice in the staffing sector, and generally speaking, management teams want to come to Impellam. I would say that, wouldn't I? But the benefit to investors of that is that we are acquiring these businesses at very good multiples, which is driving shareholder value. Another significant thing we've achieved this year is customer retention, and I'll talk about why that's important to us. But in our top 50 customers, that's 60% of our margins. We've retained 96%, which in the staffing sector is outstanding. Run through the financial highlights in case you haven't seen them anywhere else. Revenues last year, just under 1.8 billion, and that was growth of 34% on the prior year. That is a mix of organic and acquisitive growth, and we'll split that out for you a little bit later on. Our gross profit up 20.5% to 233.7 million, and our operating profit up 39%, haven't got my glasses on, to 52.9 million. And our final dividend was 10 pence, which was ahead of the city expectations, and certainly significantly up on prior year. You can see the progression through 13, 14 and 15 there. And that's probably a good time to talk about our share price performance last year. We opened last year on just over £5, and we're currently trading at 8.52. We manage and measure the business in terms of a group of KPIs. And now that the strategy is in full flow, we're able to look at some of the things that drive our performance, not just the financials. Key things we look at is conversion ratio. This is how efficiently and effectively we convert our margin to profit. At the start of our 3-year plan, which was last year, I said to Darren, who will join me in a moment, that we could get our conversion ratio to 25% from just under 20%. He kicked me under the table. I said, no, we can, Darren. And we made progress in 1 year. We took it from just under 20% to 22.5%. And we certainly see now that our 25% target is very achievable. We see conversion ratio as being the real sign of efficiency. It means we get it right first time. We're not doing a whole load of rework and replacement of people. The other thing we look at is cash. All businesses need to be careful with their cash, and we're no exception to that. We ended the year on DSO of 33. That is an industry-leading performance. Most of our peer group would be on debtor days of between 40 and 50. Why is that important? It gives us flexibility and agility to do other deals. So whilst we have borrowed money to do our most recent acquisition, we intend to delever down very quickly on the back of the cash that we generate. In terms of measuring the progress on the strategy, we look at client retention, which we've already talked about, 96%, and we also look at staff retention, which is 60%, and that's something we are looking to achieve, to improve. And we also look at how satisfied our customers and candidates are with us and our employees, and we are seeing an increasing trend there. The reason that's important is our business model is all about high retention. We believe that if we keep our people for longer, they'll keep our customers happier and our customers will stay. And you can see the evidence of that in our customer retention of 96%. Equally, keeping our candidates happy is very important. Staffing companies who have the best relationship with candidates are the ones that are increasing their market share. And as a consequence of all of those things, we look after our investors. We're organised into 2 segments, managed services and specialist staffing. And this is a key point of the Impellam structure. What a managed service does, it optimises productivity of people in a customer's organisation. So to take one of our customers as an example, John Lewis, let me explain what we do for John Lewis. So we are the single point of contact for all contingent labour and contract staff in the driving, logistics, IT and head office space. We have a team of on-site people and a proprietary IT system, which means from order to pay, we manage that process for them. And we fill their requirements either directly through our own group companies or through a supply chain. So we're able to flex our margin based on the percentage of group fill. That's what a managed service is. The reason we like managed services is it gives us visibility and control much further than in traditional staffing. These are 3 to 5 year contracts. We're sticky with the customer with our technology, so we would generally renew them twice, if not 3 times, giving us a 10-year-long relationship. The cost to serve is lower than in traditional staffing because you have a high number of service people rather than salespeople. So our conversion of margin to profit is high and increasing. So this year we increased our gross margin conversion from 25% to 30%. This is our direction of travel because this is how customers increasingly are buying these type of services. This year we completed on the acquisition of Bartek, which is a North American business, and that was to strengthen our position in managed services, but also to strengthen our performance in North America. The other part of our business is specialist staffing. This is the more traditional staffing business, and here we have a portfolio of brands. We're a house of brands, and we believe that gives us an advantage because it means that we can acquire businesses fairly easily and put them into our structure. We can also divest if we choose. Another real advantage of the multi-branded approach is it's good for attracting staff, keeping them engaged, giving them good career development, because each and every one of these businesses has management teams, which means that people can see a clear career progression. The key to what we're doing is managing the portfolio between specialist staffing and managed services. Most staffing businesses are cyclical. In fact, we are seen as a bellwether of the economy. Staffing businesses tend to react before the economy does. You'll be pleased to know we're still performing well. But the whole structure is intended to be more resilient than a traditional staffing business because we own customer relationships through our managed service brands and we can fill through our specialist staffing brands. In a downturn, we will feed family first and smooth out the peaks and troughs of the cycle. Our specialist staffing businesses are higher margin than our managed service businesses because we don't have so much visibility. And here we have increased our margin percentage over the last 12 months by 0.5%, which on 700 million of revenue is no small number. And as a consequence, this segment has grown its operating profit. I'm going to hand you over to Darren now to talk you through the key financials. And Darren, I've left you 10 minutes. I only took 50% of the time.
So I've got a few slides on financials, not too many. That's our P&L. Julie's already talked about many of these metrics. When we're talking to investors, we normally point out a couple of things. One, we did raise £250 million last year, late last year, 4-year revolving credit facility, which replaced all our other facilities. And I'll come on to talk about where we finished up the year and why we took that out. That has meant our interest charge has clocked up a little bit, but we have spent over £100 million on 2 acquisitions last year. The other thing to note from an investment perspective is our tax rate. So our tax rate this year came in at 10%, which is remarkably low. We do have substantial tax losses in the US. So having bought a very profitable US company and with synergies to come out of the combination of those, we're now very confident about using some of those losses that we have. And the losses have got quite a wide range on them, somewhere between $80 to $250 million of losses in the US. Complicated piece of work to go on and actually quantify exactly how much of those losses are still around and how much we can actually use over the next 5-10 years. But suffice to say, we don't expect to be paying tax in the US for quite a long period, whether that's 4 or 5 or 6 or 7 years. So we're kind of guiding people to an effective tax rate and a cash tax rate of 15% on a going forward basis, which is good for investors. Julia mentioned the financial highlights. We have had, obviously, 4 acquisitions over the last 2 years, so consequently trying to work out what is our organic performance and what is our acquired performance is quite tricky, and we did promise investors we would give them the full picture. So our revenue growth organically was 3.4%, which we think compares to a market of about 3.7% in the markets in which we operate, so that's pretty good. Our challenged business last year was our North American business, which is particularly our specialist staffing business. So if you were to exclude that business and exclude our Carlisle Support Services business, which was a small business which we were shrinking in order to make profitable, then you'll see our growth was nearly 7% at revenue level. On margin, actually, which is our better metric, actually. So revenue in our business is interesting, but not that interesting. What you should really be focusing on is our margin and our margin growth. Organically, if you exclude North America and Carlisle, we grew at 4.5%, which we think is a good performance. And again, at the bottom line, from an operating profit or an EBITDA level, we grew just over 10%, nearly 11% at an organic level. And again, if you were to back out the impact of that North American business, you'd see that's nearly 25%. And that's really down to the focus on conversion. So we've been growing organically, as well as acquiring and growing those businesses as well. But we've also been focused on converting more of that margin to bottom line. Overall, if you were to strip out the North America piece, the North America specialist piece, you see that 40% of our growth this year has come through organic performance. And that's quite important because I think there might be a perception out there that it's all acquired, and it's not actually. We are continuing to grow. And we've had some very strong organic performance in some of our segments, and you can see we're in many different verticals in several different markets. This is our balance sheet, and I put this up for a couple of reasons. One, just to show that at the year end we had just over £500 million of debtors. So as Julia mentioned, we have a couple of billion of revenue, and then about 4 billion we manage on behalf of other people, which flows through our account. So we've got about 6 billion pounds flowing through, £500 million a month. So we're a big company, and clearly we want to optimise that and be as efficient as possible. We did take out a revolving credit facility, £250 million. We finished up the year end at £180 million net debt, which is broadly where we expected it to come out. We're anticipating putting our foot on the ball a little bit on our acquisition strategy, certainly for the first half. We continue to talk to lots of people. We continue to see lots of things coming across our desk, but we want to be confident that we're going to delever in the second half of the year before we start spending again. So if we focus on conversion, we focus on our cash, we would expect our debt to be down sort of circa 95 million, between 90 and 95 million at the end of 2016, which will kind of be down at 1.2 times level, and that's we feel comfortable with that, and we'll start spending again over the second half. We did gear up to 2 times net debt to EBITDA. Doesn't sound a lot. That's quite aggressive in a UK context. You went to North America, they'd say 4 times as aggressive, but hey, we live in this world. So we're a big company. We are, our growth going forward is going to be through a combination of organic performance, but also acquisitions, the right acquisitions in the right places to fill some of the verticals that perhaps we're not strong in, or maybe some of the geographies that we're not as strong in. But that's going to be second half of the year, not first half of the year. Left you.
Together. You've heard us talk about North America a little bit there, talking about the performance without North America. The reason for that is we have fixed that underperformance now by the acquisition we did at the end of the year. So that was an important strategic acquisition for us to put more volume into our North American business. We took some cost out, but the important thing we had to do was to get more volume into the existing infrastructure. So that's why we've been referencing it. We've edited down a 45-minute presentation into 20 minutes, and I suddenly realised the story didn't quite hang together there for you. 2 things I'm focused on for 2016, or 2 things we're focused on for 2016. Clearly there's a lot going on. Clearly we've achieved a lot in the last 2 to 3 years, and there's a lot more still to do. The things that keep me awake at night, the things that keep me focused, the things that Darren and I talk about all the time are these 2. Number 1, people. We are a people business, and key to our success is attracting and retaining, rewarding and engaging our workforce, and making sure we drive that high retention strategy, because we now have evidence that the longer we keep our people, the longer we keep our customers, the longer we keep our customers, the more they spend with us. The second thing is the thing that Darren just spoke about, making sure that we optimise our cash and debt management. As Darren said, we increased our borrowing to do the Bartek acquisition, which was absolutely the right thing to do. Very cash generative business, and our focus now is on bringing that debt level down, not just to make me sleep at night, although that would be nice, but also to give us the flexibility and agility to go off and do other acquisitions, or to invest in technology or invest in our people. So people and cash. Speaking this afternoon at a recruitment industry event, and there were 300 odd people in the room running small, medium-sized businesses, and actually at the end of the day everybody who runs a business has those same 2 issues, don't they? People and cash is what it's all about. So we finished in 18 minutes. Well done us. So I guess it is time for questions.
You made a very good point regarding the staffing industry being an economic barometer, an economic bellwether, I think the phrase was used. I just wondered, A, do you anticipate any impact on the business in the event of Brexit in June? And have you made any contingencies, either in a positive or a negative context, in terms of protecting or maximising shareholder value?
With specific regard to Brexit? Yeah. You would expect us to, with a portfolio of our size, to have a range of contingencies that balance out across the whole portfolio. So we've got a couple of things going on in the marketplaces at the moment. Today, we have no sign of any fall off in the marketplace. In terms of our portfolio, if you look at the sectors we're active in, we're in healthcare, we're in science, we're in IT, we're in blue collar. These markets are pretty resilient. And add to that the balance of the managed services and specialist staffing, which is the key part of the strategy. In terms of Brexit, as you would expect, we use European labour. That's the biggest impact, the most immediate impact for us, depending on what happens with labour mobility, should that be the case. Blue Arrow, which is our blue-collar business, 25% of its workforce is European as opposed to UK domicile. However, there is already a real shortage of labour in the UK, so if that dried up, it would push pay rates up, and then we would be able to use local labour. So it's a supply and demand issue. If pay rates go up as well, we charge a margin on pay rates. That's advantageous on our margins. So that might sound a little bit counterintuitive, but we're not saying we want to come out of the EU. We're not saying we want to stay in. We have theories about how we'll deal with both, if that answers your question.
It does,
Yeah.
because I can see the upside.
Yeah,
It's the outside.
exactly. And like all these things, it's how you deal with them as opposed to the issue itself. The staffing industry has been behest with all sorts of issues, from paid holiday pay and agency workers regulations, and we always find a way to work through them by adding value for our customers.
Next question.
Hello, hi. Thank you very much for the presentation. I've actually got a couple of questions.
Good.
Firstly, picking up on the net debt. Looking back 2 years, you were actually cash positive about 8 million. That dipped to minus 15 last year, and then it's now 118 down because of the 2 acquisitions that you had. So at what point do you expect to become cash positive again? That's question number 1.
Mm-hmm.
Question number 2, picking up on the share price growth. You mentioned that it went from about £5
Five
to
something.
about
8.50 odd today.
Looking back a bit further, it's actually gone a lot further than that, from about 20p up to about 8.40.
It certainly has. So
As of the close today. So my question on that front is, other than the 4 acquisitions that you've had in recent times, what other strategies do you have looking out for the next 5 years to maintain that kind of share price performance going forwards? Thank you. 2
very good questions. Darren, do you want to do the debt one?
Yep. So assuming we don't do any acquisitions, I mean, clearly part of the strategy is to... The reason we took a revolving credit facility, a 4-year deal, is because we want to actually spend money. So if we weren't to do any acquisitions, then I guess we'd become cash positive somewhere around 2018. But I think that's very unlikely, because I think the strategy is to continue to do a combination of organic and acquired growth.
Does that answer your question? On cash? Okay. In terms of the strategy moving forward, yes, we've had nice growth, haven't we, in terms of our share price, 22 pence at the time of the merger, which was in 2008, to £8.50 now. We have some happy shareholders, particularly in Holland, who have been with us on that journey. The share price growth in the life of this business plan, in my tenure and with Darren, has been from £3.65 to £8.50 on the application of this high retention strategy. And I would say we are only on that journey. So we certainly aren't the world's most trusted staffing company yet, but we have made good progress towards it. So I do expect to see continued progress, just keeping doing what we're doing. In the annual report, which isn't out yet, although the black and white is on the website, I talk about we're not for turning. It's working. We're going to keep doing what we're doing. I've already talked about being careful with our cash to make sure that we don't lose track of that. And I think it's fair to say, if you do any industry comparisons, any peer group comparisons of staffing companies, you will see that our stock is very good value. So there is still, one might say.
Is it a P/E ratio of 10, I think?
It's not even 10.
Not even 10.
No. No, not even 10. So there's still room to go. We are building up a head of steam into our strategy. We're getting a lot of attention. People like us, like the story. We're attracting great people and great businesses into the group. So I haven't got anything wild and wonderful out there. I can tell you that we are investing in a new CRM, and that will drive some efficiency. I can tell you that the North American acquisition we've done will improve conversion. We can see that already. But it's good.
Yeah, we've got some good growth coming out of both of the acquisitions in 2015 through the synergies that they're both going to drive, and that's outside the UK. So, you know, there's substantial amount of synergies to come out of North America over a 2 to 3 year period.
Thank you.
Good questions. More questions than anybody else? Oh, this is easy, isn't it? I'm just going to go along this line. Do you two want to have questions as well? Gentle down here.
When you put up the statistics, I think one of the statistics was staff turnover. Now, I don't know whether that's your people that work for you or
Yes, it is.
or
It is the people that
contractor.
work for us, yeah.
It showed 39.2% in 2015. I seem to think it showed a much lower percentage of staff turnover in the previous.
It's gone up a
2
couple
years.
of percent this year.
Is that a problem? Is it something
It's-
that you're not as trusted by your staff, maybe?
I would look at the Net Promoter Score that's on the same slide, which is 60%, which is about staff engagement. The staff engagement will drive the staff turnover. So I'm not excusing the 39%, and I want to see it closer to 30%. And we've got mechanisms to do that. I think the percentage movement is 2%, so the scale might have looked a bit bigger. And it's, again, that's why I've got to focus on people. I've got Director of Talent who's working on that. But staff engagement is at 60% on a Net Promoter Score, and that's real progress. Anything over 50, Net Promoter Score are the people who are real ambassadors of the organisation. Anything over 50 is considered to be exceptional. I don't think we're exceptional yet, but we're on that journey. So we're improving. The 2% difference year on year, I can't tell you what I contribute that to. All I can tell you is overall I'm looking to get it down. Otherwise the strategy will dip.
Gentleman there with the mic, and then
I saw on the balance sheet that you had rather a large figure for goodwill, almost £300 million.
can you put the mic just near your mouth? I'm sorry.
Sorry, did you hear that?
£300 million of goodwill.
Yes. I wondered if you're writing that off over a period of years and how it might impact on your ability to pay dividends.
Well, obviously we do write off some of the intangibles, as everybody else does over I can't remember the period actually, I should know it, but 10 years I think we write off intangibles. But a large proportion of that goodwill is fixed. So, yeah.
Gentleman there with the glasses, Chris.
You mentioned your staff and you're very proud of your staff. Could you tell us what your policy is regarding the living wage?
Indeed, I can. So a big part of our strategy is enhancing people's lives. When I talk about providing fulfilling job for people in a sense of purpose, that goes through all our sectors, from blue collar right the way through to our doctors, accountants and other professionals. So our proposition to customers is that we don't provide you with the cheapest workforce at the cheapest margins. Actually, we provide you with a productive, engaged workforce who will do better work for you and get the work done more quickly. What that means is we are advocates of the living wage, not just internally, but with our customers. So an example of that is we work with customers who treat their workers fairly. Some well-known people in the press you probably will come across. So if I give you an example of the customers we would work with and the customers that we wouldn't work with Sports Direct. We would work with Marks and Spencer's. And when we went to Marks and Spencer's and sold them our proposition, they actually paid 16 pence an hour more margin because of our approach to productivity and living wage. So that is our philosophy.
Thank you very much.
Thanks.
Can I just clarify the goodwill question? Because I think I've just got what the question
You figured it
actually.
out.
I did actually, sorry. Obviously, if there was a diminution in value of any of those assets, then we would have to write it off. I mean, it's a small amount going through our P&L on an annual basis, but our acquisitions have been very successful, and we're very comfortable with the carrying value of that goodwill.
Gentleman at the back.
Could you just talk us through the payment of dividends through Hawley and then through Normandy and why that structure is in place?
Sure.
Yeah, that was we kind of take into account all our shareholder views on dividends. So shareholders had a choice as to whether or not they effectively took cash or entered into one of those particular structures. And shareholders made up their own mind depending on their own circumstances.
But that structure was driven. That structure was driven by one particular shareholder, presumably.
As I said, we take into account all our shareholder views when we issue our dividends.
You will have noted that our last dividend was cash. Final dividend. And we listened.
And have you got a progressive dividend policy?
Our dividend policy, actually, given our investment strategy, is to maintain our dividend between 4 and 5 times, actually, of EPS.
Okay.
So, as our EPS has been growing, we've been increasing the dividend at a good rate.
So you don't see any reason why that shouldn't
Nope.
continue. Time for one more question. No hands? Thank you very much indeed. Thank you both.
Thank you.
Thank you.